Hello, welcome back. This is Patrick Bartolotta. I want to jump back into our valuation series. The third one I'm going to cover right now. Hope you listened to the first two. But I want to talk about valuation methods and approaches. So let's get right into it. The couple things I want to mention here is that we're going to talk about, how do we think about determining an intrinsic value for a company? The basic idea here is that we might believe, I'm not saying we should or that we must, we might believe that a company could be valued differently than the market. So the idea of an intrinsic value is we ourselves, an individual, a firm, whatever, we're going to go out and try to estimate company value by looking at the revenues and expenses and how that translates to cash flows over time. And then naturally what we do there is we would take the value we get from our model and compare it to the current market value or even sometimes enterprise value to see if the company we believe is over or undervalued. Now, just because our value is different doesn't mean it's over or undervalued. We would just want to think about, do we make mistakes and which mistakes we make, et cetera. But it's a starting point for that conversation. Other things which I'll cover way at the end is a little bit on relative valuation when we use one or two financial metrics to try to make a determination for valuation relative to other companies. And then the valuation of assets, options, and other arrangements. To be clear, I want to kind of narrow the scope of this entire 7-part series. We are talking about valuing businesses only, those not facing bankruptcy. This is not liquidation value and not about to be acquired. So we're not dealing with control premiums or anything like that. The return, therefore, is from the business operations, not appreciation of assets. So I don't want to get into what about a specific kind of holding company, et cetera. And I definitely don't want to cover the idea of option value. So like a biotech or pharmaceutical company could have like an outcome of a blockbuster drug or virtually nothing. And so valuing a business, focusing on revenues and expenses is our clear focus. I'd actually say if that's your goal, if that's what you're going to be doing and spending your time on, I should be able to give you a comprehensive set of stuff for that to consider and really focused on the drivers of value, revenues, and expenses. If you are looking to get into valuing in a very unique arrangement, I would actually check out the NYU finance professor Ashwath Motoran's YouTube valuation series. I think that I'm adding this because I think there's a lot we can add in terms of revenues and expenses and core businesses. But I think he does an excellent job of kind of covering all these kind of unique approaches to valuation, which I'm not going to cover, option value, asset values, et cetera. I'm not going to try to attack them here. So let's jump into it. Here are our steps. I've covered these before. If you want to remind yourself of it, please do, but I don't want to read it to you again. And then here's our goal, basically to estimate intrinsic value of a company's market capitalization. We can use 3 common methods. I'm actually I'm going to focus my time here on discounted cash flows, specifically free cash flow to the equity holders. You can also use residual income model or dividend discount model. I won't cover them in detail. I would actually argue, though, they'll give you the same result. I will quickly highlight residual income model, and I can probably spin up another little course on that one. I wish it was more common, but it's not, because it just gives us this straightforward lens into valuation of a company, where basically we're trying to look at how do our revenues and expenses translate to an amount of net income above and beyond what's required, and that amount is basically our way of looking at valuation. It has fewer steps and fewer adjustments and just like zeroes in on revenues and expenses. If that amount is higher than what we expect or demand, then we can create value. But I'm going to cover free cash flows, discounted cash flow valuation models because they're so common. Not necessarily because they're better in any way, but because they're so common, it's worth covering. Doesn't make a ton of sense to do valuation without getting into the most common methods of doing intrinsic value. So what do we have here? We can use any of those methods. They should give us exactly the same answer, actually, no matter what method we use, as long as we don't make mistakes, to determine the market capitalization of a company. And also, if you're ever in a situation where you need the enterprise or total company value, you would have to add in the debt or the preferred value of stock, the value of the preferred stock. So enterprise's value is basically the total company value. Market cap is the total value of equity. I'm going to focus on the market cap here. So we're like deciding whether or not we should buy a stock, and is the stock over or undervalued as a representation of our share of equity ownership. But if you needed to do enterprise value, it's a very simple thing to add in here. you're not done by using market cap. You simply have to add in the fair value of the debt and any preferred stock if there is any. But that's it. So like say, hey, I need enterprise value. Okay, estimate the market capitalization as we're going to cover, and then just add in the fair value of the debt, which is commonly it can either be on the balance sheet or actually obtained in the footnotes, but it'll definitely be one of those two places. So the focus here is on market cap. If you need an enterprise value, you got one more addition step to cover. All right, company value is what? Let's just give some perspectives on this. It's the income is the wealth. What is the idea of income? Income is wealth created by the company. Wealth can translate to cash flows, and then wealth can be distributed via dividends. So I want to be clear that that's kind of the background of why the residual income, free cash flow, and dividend discount miles would all give us the same answer. So just to repeat this one more time, the value is the present value of the incremental income earned, which would be kind of most directly reflected by a residual income model, but they're all going to be the same thing. That income itself naturally translates to cash flows, and then the cash flows, which are free or can be freely distributed, are what we could distribute as dividends. And so in different ways, we're valuing businesses. This is simply ways of like, how do we approach our model, but they really all should give us exactly the same result if we do them correctly. All right. So let's just step back and cover these a little bit. I mentioned a little bit of this in the beginning, but I'm going to kind of give a little bit more flavor to some of that conversation. What is income? Revenues earned in a period minus the expenses incurred for resources consumed. Think about cost of goods sold or advertising or stuff like that. Also, minus a portion of consumption for resource that will continue to create future benefits. So it's not fully used up. It still has some value, but it's partially used up. Depreciation, amortization, reflecting resources consumed during the period to generate or run our business, generate revenue. Minus a consideration of expected future outflows and resources consumptions going forward. So the accrual for warranties, taxes, pensions, stuff like that. Those all actually reflect through accrual accounting, like the anticipated future cash outflows, I guess, because these are expenses. But all of this stuff is getting at income basically tries to represent the wealth created for the investors in a period. That's what we have there. Cash. Well, what's the reason why in the long run cash should approximate that value created? Well, we're assuming revenues will be collected. And if not, we actually have methods of accounting for the amounts we don't expect to collect, the allowance for bad debts and stuff like that. And the expenses incurred for resource consumed, we must be paid. Like there's no way where I'll run my business by never paying my suppliers. You might not have paid them by the end of this fiscal year or this particular week. That's fine. That's going to happen. But there's still no business where I'll never pay my suppliers. And so if you think about this, it gets at revenues, basically your big prediction of future cash inflows, and expenses are your prediction of future cash outflows. So minus a portion of resources that will continue to create future benefits. Assets used up must be repurchased. So if you think about that, that's a good reason why something like depreciation is a good predictor of future cash outflows, future or contemporaneous cash outflows. As assets are used up, as we have a refrigerator, right? It stops working. We run a grocery store. We're going to spend cash, replace that refrigerator. We're not going to do it every year, but often enough. And that's going to be basically like our depreciation is going to be a proxy for the cash flows we're going to have to spend to stay in business. All right. The same idea that the warranties, taxes, pensions, all this stuff are going to have to be paid. So I guess in many ways here, I just want to emphasize that like the cash and accrual accounting story should be the same. Because we're not running a scam or a Ponzi scheme or something like that. So what are free cash flows? It's what we generate from revenue that we are after, then partially used up by expenses, used up for growth and stuff like that, but can be freely distributed. The biggest driver of free cash flow is our ability to have revenue greater than expenses over time. All right. The cash inflows from revenue that's not consumed by either current expenses or invested in net assets, which can include things, net assets like property, plant, equipment, and everything else. That is the cash can be freely distributed to providers of capital. So I want to emphasize your primary driver of free cash flows is your ability to have revenue greater than your expenses. You portion some of that for future investment, and the rest can be distributed to your investors. All right. For each period, I'm restating some of the same things. I just want to make sure we're clear. Income measures value created. Cash is essential for determining liquidity in the current and forecasted periods. It's the business activities that create value. It's represented via accrual accounting, and that can be the value created can be translated to cash, and that's useful for assessing liquidity. All right, let me go through a couple quick examples here, but we shouldn't take too much time on this particular topic here. If you think about cost of goods sold, it's both an expense and a cash outflow. So what do we basically have there? Well, cost of goods sold is going to be a representation of the non-cash calling it non-cash, which it technically is not very useful. Really, nearly all expenses are non-cash. So I want to step away from a bookkeeping lens, and this is going to really make a difference when I show you a simpler way to do a discounted cash flow valuation model. I want to step away from labels, stickers, and just pure bookkeeping. So we actually don't need to worry about this term non-cash, which technically would apply to virtually all expenses, including cost of goods sold, because the journal entry here is going to be debit cost of goods sold and credit inventory, meaning I didn't credit the cash account. But naturally, we can just jump to, yeah, but what does that mean? So I'm going to have to do what? If I use up inventory for cost of goods sold, I'm going to have to replace that inventory, meaning at some point I'm going to have to buy more inventory, which is my debit inventory, credit accounts payable. And then I'm going to have to debit accounts payable and credit cash pay for those things. And so in valuation, if you think about it, cost of goods sold is how we represent the cash outflows associated with inventory required to maintain our current levels of revenues or earnings. So I want to emphasize this. De-emphasize bookkeeping terminology. People who talk about non-cash. That's just bookkeeping, right? It's a bookkeeping terminology, and it's not useful for those of us who are trying to think about valuation. In valuation, think about how things work over time, right? I have an expense, cost of goods sold. Then I need to do what? Buy more inventory. Then I need to do what with that inventory? Pay for it. So all expenses are naturally going to be representing the cash that's going to be consumed in running my business. And as long as I want to stay in business, I'm going to have to keep spending cash to replace inventory, to have revenue, have earnings, everything else. I mentioned that point to actually lead us to the second one, depreciation. Commonly, people waste time talking about this as a non-cash expense, and this increases the mistakes in valuation and makes it really hard to kind of think about the way the piece of valuation work together. So I want to recommend not doing this, and I'll show this specifically in our discounted cash flow valuation model. But here's kind of the setup for it, right? Yes, you could argue that in a bookkeeping lens, depreciation is non-cash, but that doesn't really mean anything in a valuation lens, and that's our lens, right? Hopefully you're not sitting here listening to this just to say, hey, how do I become a bookkeeper, and how do I focus on stickers and labels and silly little things that have nothing to do with company performance, like the term non-cash. We don't need that, right? We can just focus on what matters here. Well, guess what? Depreciation works basically the same way as inventory does, or cost of goods sold. When we record the expense, we don't credit the cash account. But if we want to stay in business, we're going to have to re-spend cash, my debit, property, plant, equipment, and credit cash. If I want to stay in business, when assets get worn out, I have to replace them. So in valuation, not in bookkeeping, obviously there's a big difference here, but this is not about how do you become a bookkeeper and focus on specializing on stickers. In valuation, depreciation expense is how we represent the cash outflows related to property, plant, and equipment required to maintain our current levels of revenues or earnings. And so it's like maintenance CapEx. So it's like, how much do I have to spend in cash to get at my ability to stay in business with revenues and earnings and everything else? So depreciation is non-cash from a bookkeeping perspective, but in valuation, we can just focus on what it really is. It's a use of resources, and I'm going to have to keep using those resources as long as I want to stay in business. It works the exact same way at cost of goods sold. We usually don't talk about cost of goods sold being a non-cash expense in valuation. It's absolutely a non-cash expense in bookkeeping. It's exactly the same as depreciation. And I want to move away from those labels and towards substance. Substance meaning expenses represent resources consumed that have to be replaced in cash. In the long run, right, we're going to think that every expense is going to be a resource consumed that has to be replaced in cash. All right. Same concept. I just put those two together. I'm not going to recover this one, but if you want to kind of think about this a little more, the comment I made, specifically because I'm guessing that's actually a relatively new term. Right? Most people make a big stink about calling depreciation a non-cash expense. And that's right in a bookkeeping perspective, but it kind of misses the point of what's valuation. Valuation looks at, not just at the moment in time where the bookkeeper recorded the entry. Valuation is thinking, okay, but then what? So if I have this expense, I consume resources, aren't I going to have to expend cash to basically stay in business? And that's true whether it's cost of goods sold and then inventory purchases, or depreciating assets and then replacing those same assets. The expense is naturally a part of the cash flows themselves. I'll show that a simpler way to do discounted cash flow valuation models by just removing the stickers that distract all of us and focusing on the core substance. We couldn't generate our revenues or earnings without consuming resources, expenses during a period, such as inventory and equipment, and these resources must be replaced with cash to maintain future revenues and expenses. So I want to emphasize that, the part I have at the bottom, like that's our focus, not about bookkeeping, not about labels, not about weird ideas, but just, hey, let's focus on the core business itself. All right, let's jump beyond this. We're good on that. Also, people will commonly argue that income might have unique issues, and they're actually reasonable criticisms. But I'd actually argue that it's basically a criticism for anything that talks about the future, right? We don't know the future. So future cash flows are no more certain than future revenue. Earnings can't be manipulated. Well, really anything can be manipulated, but these are our forecasts. The methods are not perfect. I agree with all these points, but none of these are unique to earnings or accrual accounting. They're actually shared whenever we're talking about the projection of numbers. You can clearly manipulate cash flows, right? Don't pay your bills, your cash will be higher, but that's not representative of what they'll be in the long run. So you can have issues with cash and income and everything else, but the difference is in our forecast and valuation. We are making our own forecast, so we shouldn't be building in manipulations or misrepresentations or any other issues. We should be forecasting what we think represents the economic reality for the company. There are forecasts, we can take ownership of them, and that's what we're going to use in valuation. All right. Some incremental issues with cash flows that are worth noting here. You want to be sure you're good on the adjustments, which ones you're doing, kind of adds a couple extra layers there, which is okay. Some particular parts are counterintuitive, which I do want to kind of recommend. This is worth thinking about. If you think about it, capital expenditures, that's a use of cash. So our free cash flows are lower. That implies it's like destroying value, but of course it's not. It's just why we can't just use cash flows alone. Well, the more you spend on capital expenditures, the lower your free cash flows are going to be. But at the same time, that just should be hopefully translating to future revenue. So really all this stuff gets back to revenue and operating expenses. As I mentioned a moment ago, the adjustments can be really confusing. I've certainly found that in teaching students of all levels, especially those with finance backgrounds, that we really get confused with what we're doing with adjustments and why. So I think the extent we can reduce them, which I'll cover in my free cash flows, is going to be very helpful. There's a second layer of just extra caution to have with cash flows. We could include one-time or transitory items with cash flows. If you have one-time gains or losses or things in revenues and expenses, they likely would actually be in your cash flows too. So if you have a one-time gain, right, your cash is going to be higher from that as well, even if it can't recur. Working capital has transitory elements. You could not pay your bills, therefore your cash is going to be higher now. You could delay purchase of inventory, your cash flow is going to be higher now. You could collect more from your customers on account. All those things would lead to higher cash now than what it will be in the future. And just remind ourselves when we're using cash flows that cash flows are naturally more transitory, right? They're not designed to depict the core business activities being conducted. They're designed to predict cash flows. And so they can fluctuate much more. So really, I would say we're making sure that we're weaving together revenues and expenses, specifically because cash flows themselves lend themselves to a host of incremental challenges, solvable challenges, don't get me wrong, but we have to just exert extra mental effort to make sure we're extra cautious when we're talking about cash flows. So a lot of things would give us a misleading picture on valuation, except if we're saying, look, we don't need to be misled by any of these cash flow stuff. We ourselves can think, oh, this is transitory. I need to remove this. When I model this out, I can take that away. So all these are solvable problems, just extra work to be aware of. Right? Simple way to say this is it's not about earnings versus cash flow, as I've offered. I think this might be a more accurate depiction of what's really going on here. All right. I'll finish with this common misunderstanding. As we want future cash flows, we should obtain current historical cash flows to obtain these. The challenge is that cash flows don't predict future cash flows, current cash flows, right? That's why we have accrual accounting, as I've covered before, to give us a roadmap for future cash flows. The inevitable timing issues with cash flows make it harder. So the one thing I do want to mention is when you're doing a valuation, which I will cover here, you're talking about revenues and expenses that translate to cash flows. We cannot, or we're going to expose ourselves to a series of major issues if we just start with the final payout, free cash flows, and expect that we can use that and that alone. One, shortcuts are pretty dangerous. Two, if we're looking at only a summary measure, we miss out on the how. We're just getting the what, which I wouldn't recommend. And three, I think my third point here is that the big challenge is that cash has incremental issues, and we want to think about the drivers, the business drivers of cash, revenues and expenses. We will still use free cash flows, but it's the end result. That's what the business translates to. It's not the starting point of our valuation. All right, with that, I'm going to wrap up this third lesson. Fourth one coming up, where I'm actually going to get into covering a simplified version of discounted cash flow valuation models. So stay tuned.